I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Catherine Munaco. Catherine has nearly 10 years of real estate investing and operating experience. She began in single-family rentals and house flipping before transitioning to larger multifamily projects. Catherine and I actually met. We are in a mutual mastermind group, so that's how we originally met. I'm very thankful for you coming on the show today, Catherine. Thanks a lot for taking the time out.
Thanks. I'm happy to be here. Thanks for having us.
Yeah. So I'm just going to let you go ahead and tell your story, tell us your background, and then we'll go through and
Sure.
kind of dive in wherever it takes us.
Sounds great. So I actually fell into real estate accidentally, which I think is a pretty common story. But I was traveling. I was in a job where I was traveling 4 or 5+ days a week for work, and I couldn't quite stomach the idea of paying $1,200, $1,300, $1,400 a month for a downtown apartment I was going to be in, 2 nights a month. So instead, I bought a little townhome and put some friends as roommates in, and they were able to watch the house as well. I didn't know it at the time, but I was house hacking. And then a year later, somebody mentioned that to me, and I had seen sort of the returns, and I said, "This is great! Like, this is incredible." I didn't expect the benefits that I was seeing, plus the taxes and everything else. And so, turned me on to real estate in general. I consumed everything I could. Reading, podcasts, you name it. This was almost 10 years ago at this point. And then continued to build a portfolio from there. So I did a few more single family rentals, some duplexes in the area, transitioned to flipping when I'm local in Denver, and the rental market went crazy here, but the housing market was even hotter. So when the housing prices outpaced rental increases, I switched to some flipping, but always saw multifamily as the longer play, the scalable play, the way to really unlock true wealth and value. And so about 3 years ago, made the transition into multifamily and haven't looked back. I'm glad to be here.
Awesome. So, all of this start with the single family stuff and residential. Do you still hold on to any of that as part of your portfolio, and you're just adding multifamily on top of that?
Well, I do not. I have one property that I still hold on to. I sold off quite a few of them a couple years ago when the market was in a really great place. And we rolled that equity into some passive investments in multifamily, as well as some of our active projects. And so I'm largely out of single family now. I have one. It's actually my first house. It's just on a really low, like 2.8% mortgage. And I was my first one I lived in. So we had a generous mortgage rate, and it cash flows really well. And we have great tenants in it. But other than that, we've transitioned fully to multifamily.
Yeah, I find like a lot of people have done that, where they had that, sort of single family background, and then once they discover multifamily, it kind of, all right, let's let that all go. And it makes sense. I mean, especially even from just a management standpoint, right? It's a lot easier to handle or to have third-party management on the multifamily side than it is on these residential properties. So 3 years ago, you decided to make that switch. How did that look? What was that transition like for you? What kind of things did you do to kind of make that change?
Yeah, it was COVID inspired or COVID influenced for sure. I was just starting to ramp up my house flipping business. I had thought that part of it is I wanted to get out of my W-2, and I didn't necessarily see a path forward without a cash flow. So I thought, I'll flip a bunch of houses, I'll get really good at real estate, and then I'll transition into multifamily. And when COVID happened and the uncertainty in the housing market, especially in those early months, happened, it was really, I think, a gift to push me into multifamily. But I'm glad it did, because multifamily is nothing like flipping a house. And so I could have flipped 1,000 properties, 10,000 properties. I would have been probably no more better equipped to be in the multifamily space. And so found a mentorship. That was the first thing. That's where you and I have met. Found mentors and a great team to be able to sort of learn that path. Fully committed to education and the process of that. And then from there, multifamily is a partnership game. So I found partners to work with informally in certain deals and learn along the way and just offer the value I could as I continue to learn and ramp up. Formally, I met somebody in our group that my partner, Denise Piazza, and I founded One Street Capital about a year ago. But it's been mostly just putting yourself in the right networks in the right areas and learning and being willing to consistently do. Those were the two things: is access to the right education and then access to actually taking steps forward.
Yeah, absolutely. So as far as I mean, since we are part of that mentorship group together, what did you discuss like the importance of that to you in terms of your progression? I think a lot of people struggle with the idea of, sort of the guru pat where, you look at it and there's like the guru versus a true mentorship program. Maybe talk, your thoughts on that and how you figured out what group you wanted to join and everything. And I've talked about it before, so I think it'd be good to get someone else's take there.
Sure. So in terms of what group to join, I was largely opportunistic. I was really excited to be multifamily. There was this flagship cohort that was starting. It was their first time that they were launching the group. So I didn't do a lot of research into types of groups. I do recommend people do. And the types of things I'd look for are, like I said, cohortness. What type of programming are you getting? Is it raise based? Because there's a lot of raise based mentorship programs. Is it operational based? Is it a blend of it? Knowing there's like not really better or worse, just knowing what you want to get out of it. But I think the difference between that and like a guruship is just the give and take and the peer level. So access to peers in that, both from a learning standpoint. Some people were ahead of me, some people were behind in terms of knowledge and expertise or experience, but also just being able to hold each other accountable. That was one of the biggest things that came out of the first year. Is there was about 30 of us, and we were all running different paces. Some were just really just dipping their toes in. Some, like me, were fully committed and wanted to run as fast as possible. So we, from that group, we formed an organic accountability group that met on the side and talked and became thought partners and sometimes actual partners financially in deals. And that was really important. And then just the ability to ask questions. Our mentorship group has a pretty active Slack channel. I know others do as well, that you can in real time. But I think that accountability is the difference to me between a guru, like talk at you program, and a live and breathe mentorship. I will say, no matter what, though, you have to commit to action. So I think people can stay in an education and, you can watch every video in the series, you can read every book. Like, you have to at some point hold yourself accountable to taking steps. And whether that's a group that holds you accountable or a true partner in your own business or a spouse, whatever it is, I think the action is where the real learning happens. So I do think people can sometimes get stuck in the mentorship groups and not actually move themselves forward to taking action.
Yeah, no, that's a great point. And just, I mean, I've said it before, but we are a part of Apartment Addicts. If anybody's looking for a good mentorship group, it is. But the accountability piece and the action piece, right? It's the groups, I think, whatever mentorship group you're talking about, it's really that accountability between members and the I guess mentors of the group. All of that is really important, but you're 100% right. It's like, you can read all the books, you can listen to every single podcast, you can join a mentorship group, whatever one it is. But if you don't, at the end of the day, put in the work and take some action, really, you're probably just throwing away money, right? It's just not, or wasting time or whatever it is. You're not going to learn. The real learning comes from when you actually start doing. What's nice about those mentorship programs is you can start doing with a little bit of a safety net, right? So there's people there that you can ask questions and like, oh, am I going to screw this up? Or did I screw this up? What do I do now? That kind of thing. So I think having that in place, it facilitates the ability to take action, and maybe I don't know, maybe takes some of the fear away, maybe it takes some of the it shortens the learning curve, that sort of thing.
Yeah. Well, and I think I mean, I never want to be the most experienced or the smartest person in the room, right? So mentorships is and these groups that are forming, I think, are really good places to find people that are, slightly ahead of you and in whatever vein you want to describe that as. But that's something I've learned tremendously from, or just even inspired by, right? Like you get in the right circle of people that are all doing things, and the psychology becomes, well, I need to do too. Or even better, I can do this too, right? Like if
Yeah.
all these people are accomplishing it and I'm in the same seats as them, I can go do this. And so much of multifamily, but also just entrepreneurship in general, is mental and just hanging in there and
Mhm.
being able to stay consistent and believing in yourself. And I don't think that gets talked about as much because it's a little crunchy. But it's really important. And that's something you get from the mentorship groups too, the right mentorship group, at least.
Yeah. No, the hang in there part of it, especially in multifamily, I think my theory is that one of the reasons why people might choose residential real estate or choose to stay in residential real estate rather than moving over to multifamily. And I'm not even saying like moving completely. Like it's perfectly reasonable to have portions of both in your portfolio. It
Absolutely.
doesn't matter. But I think one of the reasons is the speed. And I think in residential real estate, if you're flipping houses, even if you're a BRRRR, like generally the idea is you're going to be doing many deals like quickly, right? It's like, oh, I need to flip this house. I need to get in and out of it in 3 or 4 months. It might take you a year to find and close a multifamily deal. And
Yes.
so that time in between isn't just sitting around waiting for it to happen, right? So that piece that you just mentioned about, sort of that just keep on going and moving through, you've got to keep doing all of the things that go along with it in the meantime while you're not closing a deal. Otherwise, it's just going to be harder and take longer to find and close that next deal.
Yeah. There's not a lot of daily wins like that
Right.
are big, but when the needle moves, it moves quite a bit.
Right.
And that's important to remember as well in multifamily.
Yeah, yeah, absolutely. Tell us about your first multifamily deal. How did that come about? Kind of share whatever you want with it as far as your comfort level. But yeah, tell us a little bit about how that went for you.
Yeah, absolutely. So Denise and I formed One Street Capital almost 12 months ago. We're coming up on our 1 year. And
Congratulations.
so I'll talk to our first deal at that company because I think that's where we're at. But we, you know, when you think about it, coming into 2022 was a fairly challenging time to be breaking in and being fairly new in multifamily. I'm our underwriter. I underwrote probably 1,000 deals last year. And we would offer like 20% off asking, and the deal, I mean, we wouldn't even get a broker calling us back. And so one of our strategies was, we have a lot of investors that want to deploy capital. Let's make sure that we get them a good deal and partner with the right people in the first year as we continue to try to, mine the broker network and get the right deal in the right market for us to be lead sponsors on. And so we really committed to finding right partners. We went to conferences. We have our network groups. We talked to hundreds of people to make sure we were finding the right fit. And it was ongoing conversation. So not just once. And then we looked at past deals that they had done and really tried to do a lot of due diligence on the partnership itself and mutual benefit for them as well. Are we good partners? Are we a good fit? And there was a group, a partner out of Greenville. We love Greenville, South Carolina. We had a couple markets that we had identified through a lot of analysis as well that we'd be interested in working in. And they got a great off-market deal. They wanted a sponsor to come in and help with asset management and capital, which are our two bread and butters. And so we agreed to it, and we closed with 220 unit in Greenville last year. And it's been awesome. We had a fixed rate debt, so we've avoided some of that roller coaster that people are experiencing with interest rates right now. And just a really great up and coming area. The properties, two properties, but they're next to each other, so that we're operating them as one. And they needed a lot of love, but that's exactly what we did. It's also a tax a low income, not low income housing, but a low income where we offer some of our units to the AMI restricted. And because it's a great area, so we're able to offer like really high quality, affordable housing to tenants. And really our sweet spot. That's win, 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 win as far as we're concerned.
Yeah, yeah, absolutely. Being able to, sort of make, obviously, housing affordability is a big problem
Huge.
throughout the country right now, and being able to be part of that solution while still realizing that it's a business, and sort of being able to
Yeah.
accomplish all of that, I think is a really, frankly, sort of a tricky tricky line to walk, a delicate balance, if you will. But it's really great then to be able to sort of give back to tenants and provide them with high quality housing
Right.
for something that they can afford.
And that's really important to us. We don't want to just be a private equity placement company where we just put private money into deals and then don't care about the community or the tenants. We're really big on wanting to do deals and communities where we're helping provide really quality, safe housing to people. And that's one of the reasons I love this particular property is we're able to do that. And we have still have generous returns for our investors. The tenants are super happy. They're getting new high quality product in a safe area. So it's really like great all around.
Yeah, yeah, totally agree. What's you mentioned the interest rate, I don't know, fiasco, you call it whatever you want. That the
Roller
interest
coaster
rates,
is probably the right term. Yeah,
yeah,
it's on
roller
its way
coaster is
up. Yeah.
perfect, right? But what is your take? What are you looking at? You said you do the underwriting. So what are you kind of how are you factoring that in the deals you're looking at now? What's your take on, kind of how to work within multifamily real estate with the realization that, hey, interest rates have gone up? It doesn't mean they're not the highest they've ever been in the world. So certainly people have made money in real estate for centuries. So it's not impossible. But how are you approaching it?
Yeah. So for new deals, for future deals that we're considering, we're just underwriting to the higher interest rate. And what that usually means is that the price is coming down. We've seen, and I think a lot of buyers still feel like it's 2020 and sellers think it's 2020, but buyers think it's 2008, and neither is the truth, right?
Yeah.
So there is this gap between seller and buyer expectations, but we let the numbers tell our story, right? So I don't want to be overly conservative on underwriting. I would rather be accurate and correct. And so we try to really drill into not being, I think when there's uncertainty, the default is to be really conservative, and that's good, but accuracy is even better. So we try to find that sweet spot. We are underwriting higher interest rates. We talk to a lot of lenders. So these are actual numbers for the market that we're in. I think when you stick to just a few markets, you can get really good at that in a type of product too. You start to understand what the interest rate is doing. And then what do we think rents will do? We know that we're not going to see 5% inflation anymore. Maybe even some deflation in rents. The latest articles coming out that rents might be decreasing this year over year. And so we underwrite to accurate. We put a ton of data behind it, and then really the model will tell you what the price should be. And if there's a gap and if the seller's not interested, we are just continuing the conversation. We're willing to be second or third in position if something falls through, and we circle back, and we have systems for all of that. But we won't take interest rate risk on the assumption that it's going to come down. It will. We believe it will. In 12 to 24 months. But if your deal only works on a refi when interest rates come down, it doesn't, in our mind, work. So we're just sticking to our values and our principles and letting the model tell the story. I'm a numbers person, so
Yeah.
really
Yeah.
easy to just let it tell me what it says.
Yeah. And that's what I keep getting, talk about a lot, because just the what we see, what people hear out in the media or whatever is about interest rates. That's only one of the metrics on a very large, complicated spreadsheets that these underwriting models typically are. So it's not good that interest rates went up necessarily, but it's not also as bad as everybody sort of seems to think it is. I think it's bad when you're if you're a seller and you're expecting to still sell at, when interest rates were under 3%, like it's just not going to work that way anymore. But yeah, you're taking into account interest rate, the sales price, the rents, the rent growth, expenses. There's so many different things that,
Exit.
as you
Yep.
said, being accurate, rather, because a year, you mentioned, 2022 being a hard time. 2021, 2022 was actually probably a pretty hard time, not even just to get started in multifamily, but to be involved and find deals that made sense, because everything was all the pricing had gone up so quickly, kind of the opposite of what, we think should happen now, or what some people, as you said, that the buyers maybe think should happen now, but it is somewhere in between. And so if you're truly just looking at it from a numbers standpoint, as you just said, that's it. That's all you can do. And being dialed in on the product and the market is going to help you do that more accurately. A year and a half, 2 years ago, when people were saying they were underwriting conservatively, it probably wasn't actually that conservative. Now, a lot of people saying they're underwriting conservatively, it might be over conservative, right? It's just kind of, you have to take the emotion out of this when you're
Absolutely.
numbers. It's really all it is. It's not an emotional decision. It's a math-based decision, I guess, if you will.
Yeah,
so
and
I love that approach.
I think there's something on that too. So if I may, I think that my hunch is that there's a lot of people that got into multifamily, let's say 2017, 2018, and made a lot of money in the next 3 years because of the compressing cap rate and the historical low cap rates and the historical hot multifamily market. And I think that's great. Like, I have no qualms about that. But I do think we're trying to coach our investors that the next 5 years are going to go more back to normal historical averages, as opposed to the previous five, which were the anomaly. But if you've only been in real estate for those 5 years, even a passive or active player, have a completely different lens. And so we're just again, we just come with a lot of data. And to your point, take the emotion out of it. There is not one part of our model that doesn't come with 3 or 4 data points behind it to corroborate that estimate or that assumption, because that's all a model is you're trying to make the best assumptions given the business plan and the market and things like that. And there are people that are really good at bringing data to that, and there are people that shoot more from the hip, and we try to be the former. But I do think we're going to see different headwinds in the next 5 years certainly than the previous 5, and just returning to a sense of normalcy. But it'll feel really abnormal for people that are very used to 2018 to 2023. So could be interesting.
It's definitely, I think the idea of a new normal is very true. And it's one of the things, especially as a passive investor. So one of the things that, I would say, even if we go back more than 3 years ago, 5 years ago, 8 years, you would look at the different asset classes in terms of like A, B, C, D, right? And you were supposed to see a pretty significant jump in returns as you go down.
Correct. For the risk.
The asset class, right? Right. Yeah. Risk adjusted returns. So you were supposed to see that. But what happened when all these prices went up and the cap rates got compressed? What happened is it didn't necessarily compress them equally, right? It was the cap rates on the C and D class deals that were way up here came down like this, and the A and B class went down a little bit. So what happened is that all just there wasn't much of a delta between them. And so the people, what I think we have to adjust to, aside from what you said, all of those headwinds and things like that, and the new normal going back to the way it was, I think one of the things that may not go back to the way it was is the high returns that were expected in, sort of those heavy value add deals. You should still get higher returns, but I think people are going to have to think about like, okay, and we're not going to probably see, before we were seeing people achieve high returns over these last few years because of the market and because of the cap rate compression. Prior to that, there were higher returns the more risk you took on. Now I think we're in a spot where I don't know. I could be wrong. I don't see us going back to like 8 caps on C class. Like I just don't know that that's going to happen. And so it's kind of like, what will that do to overall returns, and where's that going to show? And maybe it will, because that's going to make people have more demand for the A and B class. I don't know, but I think there's a lot of things to shake out here based on, kind of what expectations there are in the market, both on the buyer and the like the passive investor expected returns.
Yeah, absolutely. I mean, and it's also like against the backdrop of what else could you be doing with your money, right?
Right.
So, um, every investor is going to have to make their own decision. I think rents are probably going to, I mean, I know they're going to stop increasing. Like there are some markets that saw 20% year over year rents. Those days we're past those.
Yeah. That
But
can't
I
go on
was even
forever.
concerned, yeah, I was even concerned a couple of years ago because there's a lot of discussion around, well, the supply is still constrained. And that's true. We do have a lot of developments coming online in the next 24 months. So there's going to be a big influx of supply, especially in some of these bigger metros. However, even beyond that, there's an upper limit that renters can afford. There's an
Mhm.
affordability factor. And we know that, average median household incomes are not going up in proportion to rents. And so what I think is an unspoken, and certainly I don't hear it talked about a lot, is this sense of bad debt on the books. And you can build there, the market rent can be accurate and you can have those rents and achieve and put people in place. But if they can't pay that rent, if they can't pay that rent on time, you're actually not achieving those rents. And so
Yeah.
we've seen on some of our deals the bad debt line be higher than anticipated. And I think, you know, depending on your tenant base, but as student loans expire, or the stop on student loans as the forbearance expires and you have to
Mhm.
start paying those again, I think you're going to have consumer debt is at an all-time high. You've got people really constrained to pay. And I think that's going to start impacting bad debt and collections a lot. And that might be what we see, that line item in multifamily that we're watching really closely, because it's so easy to plug in like a 2% bad debt or loss to lease and be on your way. But I just don't think that's accurate in what we're going to see in the next couple of years.
Yeah, I agree. I think that's a great point, and I think it's happening. It's happening now. I mean, a lot of things happened over the last few years that literally never happened before, right? I mean,
Yeah.
we've had pandemics before, but
Unprecedented. I
like,
mean, that's
right there,
100%.
pandemic, there was a tremendous amount of money and assistance put out there to people, and now all that's going away. The assistance is going away. So a lot of this is um, probably almost assistance based, right? Like, so if you get used to having this extra money coming in that isn't part of your income for even a couple of years, like I think people thought the pandemic wasn't going to last this long as well. And so now, 3 years later, we're seeing the repercussions of what probably should have happened like 6 months into the pandemic. Like it's
Yeah.
just kind of a crazy thing. And then
I would
and
put student loans in that as well. I
yep,
mean,
yeah,
average student loan is like $800 a month. That's a rent payment in some
yeah,
market.
yeah,
So if you're not paying that right now, and instead you're taking on consumer debt, which that's the one thing that concerns me the most when I look at ability tenant to pay, is our consumer debt in the pandemic just has like exponentially increased, even with the influx of cash that went out to
yeah,
people as assistance. And so, it's rising interest rates, that's monthly payments, whether or not they're being made,
mhm,
but it's just an accumulation of, and it's all going to come back at once and it's going to impact tenants' ability to pay. And that, like I said, that's one thing we're watching
yeah.
hawkishly, because I do think it's going to impact some markets, and certainly the B and C value add plays. I think that could really impact.
Yeah. Yeah. I think that is something for sure. We talked about already, like the metrics you want to look at when you're underwriting and things like that. That is something for sure. I think people have to be uh, much more mindful of in that initial underwriting. As you said, don't just plug in, oh, it's going to be this because that's what we put in there. Like you really need to
That's
look at what it,
stabilized,
right.
right?
Yeah.
Yeah.
You really need to
Stabilized based
look
on
at
what? Historical what? Yeah.
right. Historical, that this is not historical. So you do have to kind of look at it, if you're buying an asset, what's the bad debt right now? I would plan on it being that way for a year or 2 years. Don't think that you're just going to sort of flip a switch and because I think the other thing is that it's going to be different on a market to market basis, but a lot of the counties cannot keep up with the level of evictions that are being filed and the set outs
Yes.
and things like that are ordered. So it's a challenging time. It's a challenging time for apartment owners. It's a challenging time for the people living in those apartments. It's been a lot of it's been unfortunately artificially created, but we are where we are. People need to be careful about that consumer debt. It's when we got all the stimulus money, people paid off credit cards and then just went right back to using them. And now, as you said, it's at an all-time high. So I think maybe that means we still need to keep on educating about how to how to handle finances and things like that.
Oh yeah.
Yeah, I mean, all really great points, Catherine. I enjoy this discussion. Let me switch gears, and I want to get to ask you the questions that I ask every guest.
Sure.
The first one is related to the name of the show being Know Your Why. And so what is your why? What kind of drives you forward? I know you already spoke. You're very much about action and systems and all of this. You're a driven person. What's what's the fuel behind that?
Yeah. Okay, so I come from a family of physicians, and I do mean everyone, all my siblings, both parents, my two best friends. Not my husband. I didn't marry a doctor. I really should have completed that trifecta. But and so they are able, they're able to provide really great lifestyles for their families. They're able to take care of their families financially. It's decent hours depending on the type of physician you are. My parents certainly. We grew up without wanting. We were very blessed. But I think more importantly, at the end, my parents just retired after 40 years. They were family physicians. In the course of that 40-year career, in addition to being able to take care of us and their family, they did so much good in the world, right? Like they were there for their patients in some really hard times. They kept people healthy. They were members of their community. And that really showed up when they retired, which was 3 years ago. So right around this time that really crystallized for me. I'm an MBA by training and a career in consultancy, specifically in mergers and acquisitions. So like great lifestyle if you want it to be, pays the bills that can take care of your family. But I really looked forward 40 years and realized I wasn't going to feel about that career path the way I felt, and the pride and I think what my parents can really hang their hat on. And so for me, that was a real light bulb moment that there's a lot to unlock that's probably sitting behind a 40 to 50-hour work week in terms of being able to give back to the community. So that's my number one why is really being able to unlock whatever potential I have to show up for my community, for my tribe, for my family, for my friends, and to really give goodness back to the world that I thought was being hampered by 45 to 50 hours of corporate work. But then in that, really help provide a path and education and means for others to do the same. So whatever their potential that is sitting locked behind a job or responsibilities that maybe they don't love, that's what I think this passive investing in real estate can really help unlock. So it's that duality for me, for sure, that keeps me going. Coupled with that, finance education and making sure people are more literate in finance and helping them really clean that up. I think or as a country don't do a great job teaching that to our kids and even some adults. But even beyond like finance 101, there's this like next level as I talk to investors of like really educated, brilliant people that don't know what to do with their finances. Like they've got their debt under control. They've got their 401k, and that's great. They don't really know what the next phase is. So it's kind of all that coalescing together to really help people unlock that potential, whatever that means. It's going to be different for everyone.
Yeah, 100%. I love that. I love the looking that far ahead and just thinking, okay, what am I going to look back on, in these career paths that I can feel good about, feel like
Yeah,
I, impacted
100%.
people. So I think that's amazing.
And the stuff that you feel good about won't always be stuff that is able to make money, right? And so recognizing if that's not one and the same, that's okay. I'm like, listen, I don't think money's taboo. You have to be able to eat. You have to be able to enjoy your life. You have to be able to take care of your people. And you have to be able to do it in a way that you can still have time and energy for the things that really matter. And I think that's hard. That's hard to do today.
Yeah. Yeah. But you can. I mean, that the reality is you can do both. You can make a living and also have an impact. And I think one thing that I think sometimes, and I've been guilty of this in my life too, it's like people think when I make money, then I can have an impact. And probably true that when you make money, you can have more of an impact, but you don't have to wait to have some X amount of dollars before you can
Yeah.
go out and have an impact in whatever way it is. It doesn't have to be financial. It can be donating your time. It can be, whatever it is, just educating other people, anything, really anything that can help other people. You can do that at the same time as you have a job, grow your business, have a family, whatever it is. These are, I know you're very values driven. So it's just kind of, you have to decide what are your values and what keep you, keep those in front of you and part of your, sort of everyday actions.
Yeah. And you said the right word. It's the time. It's where's your time going? And where I think people underestimate how much impact their time has, and really being judicial about where you want to spend it, because that is very finite, very. So
Yeah.
that's something we focus on and want to live a value-based decision around that.
Yeah. Yeah. One of the, one of the greatest things I feel like the things I felt best about in my entire life was I did Big Brother, Big Sister, and
Mhm.
just
It's a great
being
program.
there to spend time with that boy who grew up to be a man that was I went to his high school graduation and started it like with him when I think he was 8 or 12 or something, like a young kid. It was just like an amazing thing to experience for me. And it was like, we did things, but it didn't cost me any money. Like, it cost me some time, and it was just something that I'll never forget. I hope he doesn't, but it's just kind of one of those things that was just a really, it's just, there are ways to do it without, spending. It doesn't always mean money.
Well, one of the things, Jason, if I can just harp on that, that I
Yeah.
think is a really good reflection, and it's a little off topic of the podcast, but I think it's important since we're here, is asking yourself, like, if I could make the exact same amount I was making today, assuming that's steady state enough for you, like, what would I go do? And I think that really, like, if you just were handed a check, but you could go do anything else, I think that question is one of the more interesting ones I've asked and gotten some of the responses, and it really gets people thinking about, what could I do? What do I really want to spend my time in? And so, um, just putting that out there as a reflexive question if somebody wants it.
Yeah. No, it's a great thing to think about. And it's, tying it into real estate, this is where passive income becomes so
Huge.
vital, as you can, if you can formulate a plan to get yourself to that level of passive income, then guess what? You do actually have the ability to go do those things that you just, thought about with the question you posed. So it's a really, you just have to be intentional about it. You just have to decide that this is what I want out of life, and I'm going to make it happen. And then there are people that can help you make it happen. So just it's just figuring out that what you really want. But second question for you is, tell us something about yourself that isn't common knowledge, a special skill, a hobby, something just to let people know you better. Anything you're comfortable sharing.
Sure. In another life, it feels like another life ago, I was a strength and conditioning coach. So I worked with, at the time, usually college athletes, but I was at the University of Michigan in their program and had just some access, worked in a local like strength and conditioning clinic. And it was awesome. It was, helping athletes get to the next level, whatever that meant for them, recovering. I got to work with some awesome people and be in a really cool environment, but feels like forever ago. But yeah, that was my first career.
Yeah, awesome. Again, another way to give back. This is the as someone who oftentimes feels very old, having a strength and conditioning coach, trainer, whatever, however you want to refer to it, it keeps me going. So I think that the value provided by that career path is actually tremendously
Yeah.
impactful.
I
When
would
people, oh, go ahead.
go ahead. Sorry.
Oh, I was just gonna say, when people hear this, how can they reach out to you?
You can find us on our website, onestreetcapital.com. It's just one spelled out and then streetcapital.com. We have buttons on there that you can schedule a call from us, or you can email me, Catherine, but it's with a C, at onestreetcapital.com. But we have all of our contact information online. That's the best way to get a hold of us.
Okay. We'll have that in the show notes too, so people have it.
Great.
Last question for you, Catherine. What's a piece of advice you would give to someone who's trying to get started in real estate? They're taking those steps maybe that you were a few years back. What would you tell them?
Get a partner. even if that's not formal in your business, even if that's just an accountability buddy, have somebody that you can be accountable to moving the ball forward. I think we talked about it earlier, but a lot of people get stuck in education. And that first step is really scary. And I get it. I completely understand it. But whatever it takes to get you to take action, that's where the real learning and the real momentum is going to come. For me, that was a partner. That's why I say it, but it might look slightly different, but whatever accountability you have to move yourself forward.
Yeah. Well, and partner, I mean, can really go in so many different ways. You can use that, as you said, as a business partner, a friend, a mentor, whatever it is, someone in your life that helps you with that.
Yeah, I
that
went alone
accountability.
for a long time.
Yeah.
And it was the accelerant of having people around me. It was like gasoline on a fire. I've heard it a million times. I think there's a lot of excuses not to get a partner. I had them all, believe me. But on the other side of it, that was really where things started to happen.
Yeah. Yeah. No, I completely agree. Well, listen, this was awesome. Thank you for coming on and sharing your
Thank you for having
story
me.
and all of your insight. It's been wonderful. Thank you. And to those who are listening, I'm sure you're going to love this episode. Please like, rate, and review so we can get more great guests like Catherine. I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.